And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk about everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we're continuing on with our series on utilizing your home's equity. Since COVID, many homeowners have seen a definite increase in the value of their homes, but how can you tap into that equity for different financial reasons? And that's what we're covering through this series today. Today, though, we're going to focus on using your home's equity to consolidate debt. But before we get to that, a little coffee talk with the Joes.
So, we got the pleasure of spending a couple of days together last week, right? Thursday night and Friday. And
yes, sir.
We've done a series on PAPCAR. I don't know if people have watched that. If you please go to our YouTube channel, go back and watch that series. Joe, from what you took away from Friday and Thursday night versus what we did on our series of PAPCAR, was there a big difference in eye-opening on what PAPCAR truly is now versus what we went over on our series and how it's better utilized for you in your process of talking with real estate agents, talking with financial advisors, accountants, divorce attorneys, anybody that, you need to talk to? Did it open your eyes a little bit more? I really had that question for you.
It did. PAPCAR, you and I have known it for a couple years now, perhaps 2 years, right? Last Thursday and Friday, everything that we went through, it got so much more in depth and actual practical live uses of it, right? And actually using it. Which was so beneficial instead of just talking about it and talking about certain circumstances. For me, it really got finite, if you will, with it. I mean, we know PAPCAR, we know how successful it can be. And again, anyone that is in sales, I don't care if you're in insurance or real estate, anything, if you're in sales, please go. I think it was about 1.5 years ago that we did the series, a 6-part series on PAPCAR. PAPCAR, just quickly to explain, each letter stands for a different, right? So PCAR, prospect, appointment, present, close, aftercare, and referrals, right? So for me, as you know, since I moved to Houston, it really, I really soaked into trying to rebuild my business here in Texas, right? And this system, I walked away just hungry, even more hungry to use it, because I feel like I've been spinning my wheels a lot.
Well, if you go back and watch that series when we did it as just the acronyms, right? And we didn't really put any depth into it. And I think what we taught and what was learned, and I've been through 3 of those workshops now, helping teach, but I listen more than I talk, and that's very rare for me. And I know that was a shock to your system, but it's not just about the sales process. It's the in-depth of how that sales process works together in the things that we need to do different when we're presenting or when we're talking to people or even when we're prospecting. And I really wanted to know from you if it gave you more of that insight, which you already said it did. That's what it's opened my eyes to it, because yes, we all said PAPCAR's life, PAPCAR's a sales process. But, processes are only good if you actually know the true meaning as to why you're doing that process, in my opinion.
And the scripting of it, how, the framework scripting, the opportunity scripting, all these different scripts got so finite so granular that that's what I really took away, to be able to, instead of just being a friend to realtors or financial people, and that it's more of a partnership that I'm building by using certain vernacular in talking to them, right? so that I'm getting a positive yes instead of, a no, but through a yes.
Well, Josh Reed, we love Josh. He always comes up with these questions that make you think. And Joe, I'm going to let you answer this question. Okay, I'll put my 2 cents on this too. But if you had the ability to add an additional letter to PAPCAR, what letter would you add? What would it stand for?
I don't know if I have enough coffee in me to answer that.
Yeah, that's a very in-depth question to think about.
Take some time.
And for our viewers, I know this is our coffee talk part, but for our viewers, just kind of a refresher. PAPCAR, the first P is prospecting, the A is appointment, the P is for presenting or presentation, the C is for closing, then you have the A for aftercare and the R for referral. And it's truly a process that you go through. Honestly, Josh, we're both going to have to think about that and get back to you. I would love to know in the comments what letter you would add. I'm going to flip it back. What letter would you add? Because you've thought of this. And knowing your mind, I would love to know what your answer is, because I can't think of one off the top of my head right now. So I know that's not what our show's about, Joe, but I really wanted to bring that up on Coffee Talk. And I know I sprung that on you, and I didn't even give you a heads up what I was going to do.
Well, and I apologize. I didn't leave you a tip for serving us being a waiter that night. I apologize. I didn't tip you, so I'll have to get you next time.
But that brings up a great point of this, that dinner is supposed to be about an experience. From a service standpoint, I go to restaurants all the time with family and all that stuff, and I see what servers do. I've never been a waiter or a waitress. I was a bartender, so I know how to serve drinks, but I took that role, and Tyler even asked me if I would do it. And I was like, yeah, I don't mind putting on an apron and acting like I'm a server for the night for the experience. And hopefully everybody liked the experience. Got good feedback. But that part of it, that's a whole different coffee talk, because we could go on forever about what you learned that night. So we'll table that one for another show, and we'll talk about. But
all right,
today I'm excited. This is one of the parts that, this is how I got into mortgages, right? Using people's equity to help them get out of debt. Yes, I was in subprime. That's how I came in, right out of college, went into subprime refinances. And, I hate the terminology because it's so negative about subprime. We were there to help people that, needed to consolidate their debt, get out of debt. The reason that it got such a negative is because we never help people truly stay out of debt, right? We always help people get out of debt. And then, hey, a year later, we were probably calling them to help them get out of debt again. And that's where the subprime industry kind of went the wrong way, in my opinion. But, we need to get that stigma off of it as using your equity to possibly consolidate debt. And, this is where this show to me is probably more up my alley than anything, because there's so many different avenues. And so, Joe, when it comes to, homeowners and the dilemma they're facing today about debt, what are some things that you're seeing, or some examples that you're seeing out there on the statistics for that dilemma that they're facing?
So actually, I looked up some, preparing for the show. I wanted to get some more realistic statistics, as you put it. Our national credit card balance for the nation, everyone's credit card debt all piled together, 1.2 trillion. It's with a T, not a B, but $trillion. $1.2 trillion of credit card debt just in the United States, right?
Wow.
Now, amazingly, the average credit card holder's debt is only $7,321. So about $7,300. That amazed me. I thought it'd be more than that.
But is that based on the total population, including people under 18, or is that just?
It could be.
So if you're a family of four, you're 28,000, by the way.
Right.
So not to rain on your parade here, Joe, but
approximately 46% carry a balance for at least 1 month or more. And now this especially in where rates are today, and we'll talk about this more in depth, but according to this, the average credit card interest rate, 21.4.
Wow.
So
21.4%.
obviously there's some that are higher, some that are lower, but 21.4%
Right.
is your average credit card.
So, thinking of that, you have, average home probably has $10,000 plus in credit card debt right now.
Yep.
Let's just say at 21%, why is it so hard for them to get ahead, in your opinion?
Because they're making the minimum payments on it. That's really what it comes down to. And when I got into mortgages years ago, even just before that, as far as in financial planning that I did, it surprised me and really opened my eyes to debt when I learned that credit cards, if you just pay the minimum payment that they ask you on your statement every month to pay, that balance is amortized over 20 to 30 years. Now let that sink in. 20 to 30 years, that's amortized over. You're paying that credit card balance. That means really it's amortized really the same as a mortgage. So you can call it credit card, you can call it mortgage, you can call it whatever you want. It is a debt that's amortized over 20 to 30 years at a much, much higher interest rate.
Well, not only just a higher interest rate, it's also the way, but it's also the way the interest rate is, it's not a simple interest. Like your mortgage and things like that, where it's a compounding on a monthly basis. Your credit card is always, there daily, hitting and hitting and hitting. So, it does work out to 20 to 30 year, but unlike a mortgage interest payment, after you get through about 10 years, your principal starts going down a little quicker and less goes to your interest rate. And then after 15 years, you start seeing more towards principal. And then like the last 10 years of paying on a mortgage, you're paying majority towards a principal balance and less to interest. Well, a credit card, you're just paying the same interest over and over and over on that balance, to where it's not actually going towards. And that's what I was meaning by that. And then the other thing, and then we're going to get into the pros and cons of this stuff too, is it's kind of like paying rent to a landlord. You just, you're throwing that money into something else that's not benefiting you at all, like a mortgage would. Mm-hmm. So that kind of goes into, we talk about consolidating, Joe, right? So give me some examples of what, we're talking about today on how they can consolidate that. Because we talked about the negative. You're paying a lot more in interest. You're not really benefiting from it. And if you're making those minimum payments, you're never going to get ahead, because now you're going to go get a different credit card because you're getting a special on the percentage off of a department store or wherever you're shopping. Yep. And you're like, oh, well, that minimum payment on 2000 is going to be about $50. I can make that payment. And then you do it again and you do it again. And that's a trap we get into. I've done it. I mean, I would be one, my wife will yell at me for saying this. I've done that. In our industry, it happens a lot. So let's talk about what are some ways that we can use that equity in the house now? What are some programs that we have?
So a couple of them, just very simply. One, you can do a cash out refinance on your current mortgage, which we'll dive into kind of pros and cons on that, because I have my own feelings on that right now, especially after we've gone through, the refi boom back during COVID. Then you also have where you can tap into just the equity of your home using a HELOC or a home equity loan that is more of a closed-end second loan, if you will. Yep. So both of those. And again, we touched on this last show, the difference between the two as far as a HELOC and a home equity loan. A HELOC stands for home equity line of credit, right? Very much like using it like a credit card, so that you can buy something and you can pay it down and then buy something more. And it's kind of revolving, right? The HELOC is. The home equity loan, that is a closed-end second. It's closed because if you take 10,000, 20,000 out, to pay off some debts and that, So that 20,000 that is paid to you in a lump sum, and that's it.
Yep.
Done. Now you start paying that down, right? You can't.
So I'm going to throw my opinion out there on this. When I'm looking at helping somebody consolidate their debt, I'm looking at how are they managing their money today? How are they managing their credit card debt today? And the reason I do this as a professional, and it drives me nuts when people just like, oh, I'll give you a HELOC and you consolidate debt. I'll give you a HELOC, I consolidate debt. That is no different than you getting a 0% interest credit card and moving the debt from one credit card to another. Besides, now it's tied to your house, and you can write off that interest. Great, right? But if you can't manage your own credit card revolving debt, am I doing the best thing for you to help you truly get out and get ahead? Because one of the things you said here, Joe, was how are we getting, why is it so hard to get ahead? Well, just like on a line of credit, they have a minimum payment. It pays towards interest, it pays towards principal, but not like a closed-ended. So I'm helping you consolidate into one payment, but I'm not really helping you get ahead, in my opinion. So on that case, I'm probably looking at a second closed-ended and talking to you about planning better on, not using those cards, using checking and things like that for different things. Because, it's going to help you get ahead in life versus just keep spinning and keep consolidating and keep using. That's my professional opinion on what I look at when I'm trying to help somebody. And I have a lot of clients that come up, hey, I want a home equity line of credit. Okay. Why? Let's talk about what you're doing.
Why behind? Yeah.
And again, I'm still a big believer on a line of credit is great if you're doing improvements to your house and you don't have like a set dollar amount, doing a backyard maybe, and you want to pay it out in draws, all that stuff. A line of credit is great. Consolidating debt, it can be good if you need that extra credit, but you're paying off credit cards to try to get ahead. So we need to try to work on that cash flow more than we need to work on giving you more means to add to your debt.
And I know, Joe, you and I, we've done a lot of whether cash out refis, which of course back during the refi boom, that was huge, right? To be able to help people take 30, 40, 50,000 of debt and just, pay it all off, right? That was huge. And I loved what I did because I knew I was making a big difference in that household, that family's household, being able to take them from, a good $1,800 a month in these minimum payments and reducing it down to like, $600-700
right
a month that added to their mortgage payment, right? So reducing it by over $1,000. And to your point, as far as actually helping them, it's like, okay, you've been making this, let's say $1,800 a month payments. I want you to keep making that payment. Even though the minimum now is $600 or $700, I want you to keep paying that $1,800 because you're used to it, so that we pay the balance down quicker. Right. So that it's, if it is a 10-year, 20-year HELOC or home equity line of credit, loan, you can pay that down further, quicker, if you will. And a point I want to make that the Joe just kind of said and kept moving on here is that I don't want to interrupt when you start going, but as he said, your credit card debt, the interest, that high interest that you're paying on that, you can't write that off on your taxes. But if you put it onto your mortgage, now you're benefiting by being able to write it off. Now, in some states, depending upon where you're at and stuff, please check with your CPA, because you may not be able to write off the interest on your second lien, meaning a HELOC or a home equity, closed-end home equity loan. You may not be able to, right? With your primary mortgage, you may check with your CPA.
Right.
Typically, yes, you can. And we're going to say that, right? Because we're not CPAs, but it is a great advantage to be able to write that interest off now on your mortgage interest instead of your credit card. So you're really benefiting here in many different ways.
Well, and this kind of takes us, to why would you ever look at refinancing a first out of a 3% to 3.5% interest rate and consolidate debt? I have a lot of clients that think that way. And then it kind of opens my eyes. I got into this in 2001, and yes, we talked about subprime. It's not about what interest rate you're at today for one debt. And I want y'all to think about it, right? Car loans, I don't touch those unless you just are struggling on a monthly basis to actually make your debts and payments. And for some reason, that car loan you got was a 36-month and a high interest because that's the only thing you could do. That's a whole different story, right? But car loans, I don't touch those. Installment debts, I don't really touch those because the interest rates on them are not really there and they're closed-ended. But I look at, okay, well, if you have a $200,000 house and you have $100,000 in credit card debt, which is not, everybody's like, well, what do you mean? Well, if you only owe 200 on your house, a lot of people, that might be a $600,000-$700,000 home now, but you've ran up credit card debt that you're just like sitting there. And I've seen a lot of people with $50,000+ in credit card debt. I'm probably going to look at a first mortgage and wrap it all together. Yes, it'll be at a higher interest rate than what your mortgage is, but it's going to be a better interest rate than your combined and also your payment. And like Joe said, we're basing your savings off of the minimum payment, not based off of what you're paying.
Right.
And so, yes, you're taking credit card debt, put it in the mortgage. You're scared of that. The typical mortgage lasts for about 3 to 7 years, depending on the market, depending on interest rates. But we're in a high interest rate market right now. So I'm betting on that interest rate dropping and us being able to lower it even more for you. But you might not qualify for that second if you have a lot of debt. So I am going to look at that and figure out what is the best for you. Because if I can save you $600 to $700 a month off of your just minimum payments on everything, that puts you in a better financial situation.
It increases cash flow.
It does.
Is what it's doing there.
And so there's other loans. Like we talk, we're both in Texas. Texas, you're straight up 80% loan to value whenever you're doing a cash out on a first, second, whatever it might be. Okay. When it comes to other states, unlike Texas, you can't do an FHA or a VA cash out. Well, you can in most other states.
Yes, you can.
So what that also opens up is on an FHA, you could possibly go 85% to get the cash out that you can't do on a conventional loan. VA, you could go up higher to get cash out. It just depends on what products and programs are there. But, outside of Texas, there are those other options to do that, especially if you're struggling and let's say your credit score is in the 640s and, you need that. An FHA loan, we can come in and do that to consolidate, which will probably benefit you more than a conventional. And a lot of second mortgage companies aren't going to take it because they want a 680 or 660 plus credit score. Right. So,
and that's the other thing is that in doing this, you're talking about credit scores, after 6 to 12 months, as long as you're making your payments, right, on time and everything. Now, once paying those off, don't close them. Don't close the credit cards. Okay.
And don't let them close either. And what I mean by that is if you go to the gas station, put gas in your car, pay it off.
Right. And right then use it like a checking account. So you spend $50 on gas, transfer from your bank to that credit card, the $50 right then and there. Okay. Because in doing this, you have the ability to actually increase your credit score so that later, year, 2, 3 years from now, whenever interest rates do come down, you're in a much better position to take advantage of that.
Very true.
Right?
Very true. And that's what I want people to think about too, Joe. We talk about getting out of debt for cash flow and things like that. Well, if you're in that, your starter home, or if you're in that home where you're like, okay, we want to upgrade once rates do go down. I still don't recommend waiting, but let's say you are in that. Well, doing a refinance to consolidate debts to get your score ready and to help increase your cash flow and also help your credit, this is a time to do it, because if it takes a year and a half for rates to drop, or if it takes 2 years for rates to kind of come down to where now you're ready to do it, you're not worrying about the others. So Josh Reed's coming back in. I love it that Josh is on here. Plus, they will increase your credit lines that way. You're right. Once you pay those off, they're going to give you more of a credit line, which also helps your credit too.
And here's something to think about. If you are in the position that you are moving up, right? You're selling your home right now, and you're purchasing the next home. You're doing a move up, we call it. I want you to think about paying off those credit cards with the move, with the new purchase, okay, of rolling that in, right? Because that's, again, you're reducing your interest rate on those credit cards, which are probably in the 20s, right? If you're getting an interest rate now, plus or minus 7%, probably in the sixes, perhaps, you just reduced the interest rate by a third, okay? And everything that Joe and I are talking about here, you're going to be able to take advantage of, so that putting you in a better position when rates come down for all of that. Just don't put money back on those cards.
I mean, you can still use them. Just manage it better so you don't get back in the situation you were in, right? Joe, you brought up a good point there about paying off the credit cards. If you're selling your house and buying a new one, excuse me, utilize that $20,000. If you have $20,000 in credit card debt, utilize that $20,000 out of that equity to pay off the debt versus putting an extra $20,000 on the house. And the reason I say that is because, again, your payment on that $20,000 is going to be pretty insignificant towards your mortgage versus the minimum payments on those $20,000 worth of credit cards.
Yes.
Even if you have to pay a little bit of mortgage insurance, it's still going to be cheaper on an overall cash flow. And then that mortgage insurance, when we try to refinance it, because we are in that higher rate market right now, we could possibly see if the house appreciated and get it off at that time. But from a benefit of your own debt and all that, it's smart to do that. And that's what I tell a lot of clients is, I would rather you pay this debt off than put that other 20 over here. Yes. Take out a higher loan on the mortgage, because that payment is not going to be as much of a difference as those minimums are that you're paying on. So I really like this show, and I know we're coming to the end already. And Josh, I wanted to bring back around because, we asked Josh, what he would do, right? So I want to get your thoughts on this. I would say E, standing for efficiency, and it would be after the R. So you have PAP care. It would be a section for the salesperson to utilize, reflect, and past process and get more efficient in between each sales cycle.
Well, Josh, take that to Renee. And
it's not just Renee. This came before Renee too, but we got our coaching, and there's a shout out. We're going to shout out and thank Renee for this information, because we've taken it and ran with it. But I'm also going to give a shout out to Jay Bunty. I don't know if you were on his daily sales huddle yesterday about seller concessions. Jay talked about utilizing that on VA loans, because he does a bunch of VA loans to pay off buyers' credit card debts and stuff like that to help them. So it's the same thing we're talking about here. If you don't get the benefit of a VA loan where, you can use seller concessions and things like that to do stuff to help you out, that's where we're talking about using that equity in your home when you're selling it to buy a new one. Use that part to pay off that debt. I think that's a great way. And both of those gentlemen are awesome at what they do, and we really appreciate the information they give us, because we can use it on our show and take credit for it.
Well, we are running out of time. So real quickly, let's kind of recap a little bit and give you listeners some pro tips there. First of all, talk to a trusted lender like the Joes. They can definitely help put you in a better financial position with your debt, with your mortgage, to be able to utilize in the proper fashion the equity that you have positioning it with the debt that can be consolidated. And create a plan. Create a plan to stay out of debt after consolidation. And in doing so, the third tip I would tell you, pro tip here, is consider financial coaching or budgeting tools, right? As a part of your reset. Nothing wrong with that. Matter of fact, we should have on Brian Quinn sometime soon, Joe, and just kind of talk about, debt and credit and stuff like that, just to reemphasize some of that, because he's got some great tips on stuff like that. So definitely consider financial coaching to help you with this. So that's all the time we have for today's show. Equity can definitely be a powerful tool to help simplify your financial life. Like any tool, though, it must be used wisely. So if debt has been weighing you down, don't just make payments. Make a plan. Reach out to Joe or I for help in putting the right financial mortgage plan together for you specifically, because everyone's situation is different. Don't just refinance your debt, reset your financial future. So with that, next week, folks, tune in next week at our usual time, Wednesday, 9 a.m. Central, as we continue our series on how to utilize your home's equity when we focus on using your home's equity for home improvements. Looking forward to this one myself. Thank you, everyone, for listening in, both of you. If you know of anyone that might be able to glean from what we've covered today, or if you want to catch up on some of our past episodes, go to our YouTube channel at the Mojo Show Real Estate Podcast. And of course, while you're there, be sure and hit the subscribe button, because we are on a mission to get to 1,000 subscribers. And every comment, share, like helps us to reach more home buyers like yourselves. So before we close things out, Joe, any last words or nuggets of advice for our listeners?
Just, stop thinking that you don't have options to get out of debt. If you're a homeowner, reach out to us, because there are options possible to get out of debt. And if they're not, then maybe we can game plan what you could do for helping yourself get out of debt if you can't use the equity. Really enjoy this show. I really want people to understand we're here to help you. So again, thank you, Joe, for putting this one on and us going through this series.
Awesome. Well, I'm Joe Mortgage, and that handsome guy with the beard is Cup of Joe Mortgage, and we'll see you next week.
Mr.